As silver ETFs gain traction among retail investors, many are wondering how they compare to their gold counterparts in terms of scale, stability, and returns. To talk more on this, I have Sagar Lele with me. Thank you for joining me. So, given the relatively smaller size of silver ETFs compared to gold ETFs, what are the liquidity or concentration risks for investors, and how scalable is silver ETF adoption for retail investors?
Right. So, see, traditionally, if you look at the overall market, silver is a much smaller market compared to gold. I'm not only talking about ETFs, but in general also, silver market is about 1/10 that of gold. So there is a large disparity between how gold and silver operates. And the similar trend is seen in ETFs as well, where gold ETFs are much larger in terms of market cap compared to silver. Now, in terms of risks for investors, a couple of things to take care of is one, that there is a liquidity risk, right? And that appears at two levels. So investors can check for two things. Number one, the trading volume itself. So if the volume or the daily traded turnover of silver ETFs is low, then that could result in a higher impact cost. So low liquidity usually is risky because you won't get a good or beneficial price, and there is something known as an impact cost, which will return the average buying price or selling price for any investor. So that's one. However, the second thing to look for in ETFs is also the fact that there are something known as authorized participants which operate in the primary market. Now, these guys are responsible for creation and redemption of units. So if there is AP participation healthy in a particular underlying ETF, then you might just get liquidity which is good enough despite average daily traded volumes being low. So these are a couple of things to look for when it comes to scanning silver ETFs and maybe avoiding some amount of liquidity risk. But in general, I think investors can just go for the highest liquidity or highest market cap ETFs in order to safeguard themselves. So if I just look at the Indian market again, safely just go with something like a Nippon Silver Bees, ICICI Prudential, or HDFC. Those three are the largest in terms of market cap. So they're bound to have higher trading volumes as well as higher authorized participation. So those things would take care of it for retail investors.
So gold is always seen as a safe haven, but silver is seen as something that has industrial plus asset value. So, to what extent would industrial demand, like usage in solar panels or electronics or EVs, be already priced in, and how much upside remains if industrial demand surges further?
So here's the funny part about gold and silver. So 50 to 60% of silver demand today comes from industrial uses or industrial applications. The number for gold is at 8 to 10%. So for gold, 8 to 10% is industrial use, 50% to 60% is jewelry, and the rest of it is central banks like RBI, Fed, etc., buying gold reserves. So that's the spread. Now, what usually happens is, you're right, gold is looked at as a safe haven while silver is more for industrial use. But there is a little bit of a conundrum here where because silver has industrial use, it's actually cheaper compared to gold. Now, what eventually ends up happening is that the price disparity usually widens. See, over a 25-year period, if I look at, the disparity between gold and silver prices is about 66 to 1. That's the ratio. However, during crisis times like COVID, for example, or the 2011 crisis, or even now, the ratio goes up to 90 plus. So in fact, right now, if I look at, gold is much more expensive compared to silver, despite silver having more industrial uses. So that is something that will continue. In terms of what is priced in, I feel a lot of the industrial applications are already priced in because that's where the demand for silver comes from. What is probably not priced in is any accelerated adoption of maybe, say, solar power, electric vehicles, or maybe a new or patented use of silver which revolutionizes how things function at this point in time. Or the third thing, which is the most relevant, I feel, is any supply constraints in silver. So if there are supply constraints, then you will probably see a natural increase in the price of silver and a lower disparity between gold and silver. The supply thing is actually, again, very interesting because silver, about 70 to 75% of the time, silver is actually a byproduct. There are no dedicated or concentrated silver mines in the world. It's very rare for silver to occur in its own as an individual element. It is usually occurring with copper, zinc, or lead. So whenever miners are digging out copper, zinc, or lead, silver is a byproduct of it. So no one is, and that's why there is a supply constraint of silver, because no one is going out there and digging silver alone. It usually comes as a 5 to 10% byproduct of something else. So to answer your question briefly, gold is looked at as a safe haven, and that's what is driving gold prices higher. And because silver is more industrial in usage, I think at this point in time, it's more prone to um, economic volatility, risk from recessions, risk from geopolitical issues, etc. And that's why the price is relatively lower compared to gold.
Given silver's smaller market and relatively lower liquidity compared to gold, so how vulnerable is it to sharp drawdowns or speculative bubbles?
See, I think the volatility in silver has more to do with its industrial application and exposure compared to its smaller size. Now, because industries and businesses themselves go through cycles and silver is heavily used in it, and 50 to 60% of the demand for silver comes from industrial applications, silver is more prone to this volatility and vulnerability. So, if I have to look at some of the past periods of distress, say for example April 2025, silver was down 20%, gold was down 5%. The volatility in silver is actually 4x that of gold. Similarly, in COVID, silver prices were down 40%, whereas gold prices were down only about 15%. So a similar 3x, 4x volatility is seen in silver prices. And actually, conversely, even when it comes to recovery, silver recovers much faster and to a larger quantum. So post COVID, silver saw a rally of about 140%, whereas gold was only 40%. So thumb rule can be the 3x to 4x is the amount of volatility to expect. But just that it's not only the size that results in this volatility, it's also the fact that it's recession sensitive to a larger extent. Second, it has higher speculative participation. Because silver prices are 1/100th that of gold, retail participation or speculative participation is usually higher in silver. And lastly, because there is no support for silver in terms of demand or buying from central governments. So usually when gold prices fall, central governments like China, US, India will aggressively go and buy some gold for stability. But that doesn't happen with silver. So because of these factors, silver is always going to be more prone to volatility compared to gold.
Okay. So physical silver has higher storage, security, and purity costs compared to gold. So in the context of silver ETFs, what do you see as the drag factors? Can you talk about the storage fees and fund expenses and custody that can erode returns? And how do these compare with gold ETF costs?
So you're right about silver being more expensive to store as well as maintain. And that's a simple, I think, math equation, right? Because gold per 10 gram right now, for example, is 1.2 lakh rupees. Silver per kg is about 1.6 lakh rupees. So the amount of space required to store X amount of gold or X value of gold, you'll require more than 90 times the space to require the same value of silver. So it's very hence silver is much more expensive to store and to maintain. However, when it comes to ETFs, if I look at the total expense ratio between gold and silver ETFs, the difference will be barely about 15 to 20 basis points in India. And if I have to look at a mature market in the US where there's more liquidity for such ETFs, the disparity between the two comes to roughly about 10 basis points, which is barely anything. So compared to the actual cost difference, the cost difference for ETFs is not very large. And that can be attributed to a couple of factors, one being the economies of scale. Because ETFs have so much underlying liquidity and they're dealing with hundreds of thousands of crores of gold or silver storage, the cost gets spread over on a per unit basis. That's number one. And secondly, I think AMCs can always use external custodians to take care or store the gold. In that case, custodians will always have the economies of scale compared to someone like an AMC, which is just starting out. So yes, there is a difference in the physical market, but when it comes to ETFs, there is barely a difference, about 10-20 basis points, which can be ignored.
In a diversified portfolio today, what would be a prudent way to silver or silver ETFs? Which investor segments are best suited for silver allocation, and over what time horizon? Can you talk about that, please?
Yeah, so usually people tend to club gold and silver together when they're talking about asset class exposure or asset class allocation. So they tend to club it together and say that bullion needs to have about 5 or 10% or whatever number to a portfolio. But we like to look at it slightly differently because gold and silver are not really exactly at par when it comes to the value they provide in safety terms. Gold is considered much more safe, less volatile, has a lot of monetary value versus silver being industrial and stuff. So we don't usually like to club the two together. So I would ideally in an asset allocation strategy look at my core assets being somewhere around 70 to 90% of the total portfolio. However, I would probably allocate 10 to 30% to satellite recommendations or satellite allocation, which is more cyclical in nature, which is more trend based, which is more short term. So I would then play or place silver in that short term bucket or that cyclical bucket. And in that case, it really depends on the risk profile of the investor. For someone who is probably very high risk profile, they could go with a more aggressive 20-30% allocation to satellite buckets, whereas low risk investors can go with somewhere around 5 or 10%. And within that, again, we ideally recommend 2 or 3 different plays and not just one concentrated silver play. So to not beat around the bush and answer your question straight, it can vary between say 2.5% and 15%, depending on the risk profile of the investor. And sorry, short disclaimer, that is an ideal situation, not at this point in time. At this point in time, given the fact that silver prices are like a record high, we'd probably try to embed some amount of caution or prudence in terms of taking fresh positions in silver. If you have existing positions, great, but adding at this level is a little not optimum a decision.
Thank you for your inputs.